we're calling this one exploring the probability of touch across various deltas. And just remember what probability of a touch is. It's the chance that between now and whenever expiration is, that the option that you are trading touches the strike price. And the back of the envelope way to look at this is it's 2 times the delta. Okay, so this is we don't have to make this more complicated than it is. It's essentially probability of a touch is 2 times the delta. But we decided to take a look at probability of a touch as it applies to calls and puts, because in bull markets, you know, the calls don't the calls get touched more often than the puts. Let's take a look.
Sure.
As we discussed, that the realized probabilities of touching the strikes in short option strategies is much lower than the theoretical probabilities. This drops significantly when exiting positions at 21 days. This is a piece that we did in the past. So looking at 20 delta options here, theoretical chance of a 20 delta option touching puts and calls is 2 times the delta. So the delta is 20. The theoretical chance of touching is 40 on the calls, 40 on the puts. If you hold it to expiration in the last 10 years, because we've been in a bull market, the puts actually only have a 20% chance of touching, the calls right at 40. But if you manage early, both sides, where you'd think the theoretical is 40%, it's really only 10 and 14. That's the whole concept, the whole reason we manage early. Okay, that's cool. Let's go to the next slide. But to understand the effectiveness of the realized probability of touch, we can examine the ratio between the realized probability of touch of 21 days and the delta, which is half of the theoretical probability of touch. I know these are a lot of numbers, but the reality is for options with a delta of 20, the ratio is about 0.3 on average. So that's the coolest thing, that when you manage early, the ratio probability of a touch to it actually happening to whatever the theoretical is, it's only about, you know, it's less than a third of the time. And that's cool. Because remember, the theoretical is 40%. It's only 11 and 14. So what happens there, it averages about 0.3%. Essentially saying, you know, like there's no edge in trading, but there are these there's these things that you could understand about the mechanics of trading that are really interesting. Like if I said to you the chances of the market going down and touching a stock at a certain level is 40% if you sell the 20 delta option. But in reality, okay, if you manage early, it's only 11%. You'd be like, oh, that's cool. I'll do that.
Agreed.
That's all it is. So let's go to the next slide. However, focusing only on the 20 delta might not provide the full picture. So this time we analyzed SPY out of the money puts and calls across various ranges from 10 to 45, which are the most commonly used out of the money deltas. All options were initiated at 45 days and exited at 21 days. Let's take a look at the put side first. Next slide, please, John. So when we start to break it down, the probability of touch at expiration for all the deltas are lower than the theoretical values, 2 times the delta. But when the positions are managed at 21 days, the results improve significantly across all deltas. So did it really matter what delta that we used? And the answer is no. It actually didn't. And if you look at the actual probability of a touch, 21 days divided by the delta, I mean, these are incredibly interesting numbers because essentially all of them are, you know, significantly below what the expectations are. And by the way, we don't do 40 and 45 day options. So really looking at the further out of the money, 10, 16, 20, 25.
That is true.
Yeah. You know, obviously the at the money options are going to touch no matter what. There's a 99% chance.
Unless you get the price action movement, you know, right off the bat, 100%.
Yeah, you're not going to sell a 50 delta option and expect it to only hit, you know, it's going to 100%.
It's almost like when you put on a position, you know, your P&L is typically zero or negative a few pennies per contract. You know, rarely is it, you know, positive.
The value of this study is for out of the money options. It's not for 40 and 45 and 50 deltas. It's only for out of the money options.
Yep.
A graph makes it easier to see the improvement that exiting positions early can bring to our short put strategy. The trend also shows that the gap between theoretical and realized pot narrows as the delta increases, indicating a higher risk of touching with larger delta options, of course. And that's just, you know, common sense. But really where we are in that 15, 20, 25 area, you can see the actual versus the theoretical in purple, the actual at expiration in blue, and then the green, which is when you manage early. So now we look at the call side, which is going to be a little bit different. It's higher than the puts, but it also is surprisingly low if you manage early. So again, what we're seeing here is results that are very similar, and you can see at 10, 15, 20, and 25 deltas, the actual probability of touch at 21 days to expiration is still a very small percentage of what the theoretical would be. 3%, 7%, 14, 24. Let's go to the next slide. So we found a similar pattern in the graph. And again, positions become less effective when you have the higher deltas, but the lower delta positions, you can see how effective they are. Just look at the green compared to the theoretical and the actual. It's very impressive.
Very much so. Got to manage early. We've been talking about this, and you always remember when you don't manage early. You never remember when you manage early and it works out. It would have worked out perfectly for you. So manage early. I think managing early, 45 days. We've said it numerous times. That's putting on trades. That's been 2 keys to flatten out my P&L curve 100%. So I'm going to take a quick 90-second break.
Wait 1 second.
Oh, I'm sorry. I did the takeaways. I apologize.
Yeah. So for index options, puts have a lower actual pot probability of touch than calls across all deltas. Managing the positions at 21 DT significantly reduces the chances of being tested strikes compared to doing nothing. On average, the realized probability of touch on the put side is slightly smaller than the delta, while it is almost the same on the call side. And the difference between put and call sides become marginal when the positions are managed. So manager